You think you understand money. You earn it. You spend it. You worry about it. But almost everything you believe about it is wrong. Not what it was designed to be. Not who designed it. Not what was decided. Quietly, permanently, in the year that changed the relationship between Americans and their money forever. 1913. Most people couldn't tell you what happened that year, and the people who built it were counting on exactly that. Stay with this. To understand what changed, you have to understand what existed before. For most of American history, money operated under tighter constraints. It wasn't a perfect system. It was volatile, uneven, and prone to sharp contractions that hurt ordinary people badly. But it had something the modern system doesn't: a ceiling. The government's ability to expand the money supply was limited by what it held in reserve, which meant there were structural limits on how much could be created, how fast, and for whose benefit. Power has never liked limits. By the late 1800s, something kept happening that made those limits feel unbearable to the men who ran American finance. Panics. 1873, 1893, 1907. Bank runs, credit collapses, markets seizing without warning. Ordinary people losing everything, not because they'd made bad decisions, but because the system was fragile in ways no one had designed and no one could fully control. Each time, the same question: who steps in when it falls apart? And each time, the answer was the same: a private banker, one of the wealthiest men in the country. He would organize the rescue, gather the capital, stabilize the panic, and then send the bill. That arrangement was becoming politically unsustainable. What was needed, the most influential voices argued, was a permanent institution, a lender of last resort, a structure that could absorb financial shocks without depending on the generosity or the leverage of any single private fortune. Stable, accountable, independent. That was the pitch. But the structure told a different story. Now here's what the pitch left out. The plan wasn't designed in Congress. It wasn't debated in public. It was drafted on an island, a private retreat off the coast of Georgia, accessible by invitation only. The men who gathered there weren't elected. They were senior figures from the most powerful banking institutions in the country, representing a significant concentration of the nation's financial resources. They worked under informal conditions designed to avoid identification. The blueprint they produced became the foundation for what would eventually become the Federal Reserve. This isn't speculation, it's documented history. The participants later wrote about it. What's remarkable isn't that it happened. It's how little most people know that it did. They went home. They waited. And when the political moment arrived, the plan was ready. The moment came in 1913. A new administration, a receptive Congress, a public still rattled by financial instability and ready to believe that an official institution, something with authority, something with permanence, needed to exist. The Federal Reserve Act passed in December, and the United States had a central bank. Here's what the public was told. The Fed would stabilize the economy, prevent panics, protect ordinary people from the chaos of unregulated markets, and it would operate independently, free from political pressure and private interest. Here's what the structure actually looked like. The Federal Reserve System was given public authority, but the regional reserve banks, the operational core of the system, were built with member banks embedded at the center of their architecture. Private financial institutions became shareholders in the regional banks, participating in governance in ways that had no equivalent in ordinary government agencies. Ordinary people got the official name. Financial institutions got structural proximity to the decisions. The gap between those two things has never fully closed. And then there's the other thing 1913 brought. The same year the Federal Reserve was created, the federal income tax was permanently established. For the first time, the government had a direct, ongoing claim on individual earnings. Not a one-time levy, not a wartime measure, but a permanent mechanism. Two systems, same year. One governing the creation of money, one governing the government's access to it. Whether by design or by timing, the effect was undeniable. Before 1913, both systems operated under tighter constraints. After 1913, the architecture for something far larger was in place. Now watch what the system did. Within 2 decades of its creation, the Federal Reserve presided over the most severe economic contraction in American history. Historians and economists still debate the Fed's exact role in the Great Depression, whether its policies contributed to the collapse, failed to cushion it, or simply couldn't overcome forces already in motion. What isn't debated is what came after. The institution created to prevent catastrophe emerged from that catastrophe with expanded authority. Crisis didn't weaken the system, it grew it. And that pattern, crisis, response, expansion, would repeat. The 1970s, stagflation, new monetary frameworks. The 1980s, debt crisis, new intervention tools. 2008, collapse. The Fed's balance sheet expanded at a scale that would have been unthinkable the year before. Each time, the response was the same. More tools, more reach, more authority over systems ordinary people depended on, but didn't control. 2008 introduced a phrase that hadn't existed in the mainstream before: too big to fail. Sit with what that actually means. It means certain institutions had become so embedded in the financial system that their survival had become a public obligation, regardless of the decisions that made them fragile in the first place. The losses were shared. The gains had not been. The original promise, stability, independence, protection, had quietly become something else. A mechanism where risk flowed outward and authority flowed inward. Look at where that trajectory ends. The Federal Reserve's balance sheet today sits at levels that have no precedent in the institution's history. Interest rates have functioned not just as economic tools, but as instruments shaping which assets survive, which institutions thrive, and which ordinary savers quietly fall behind. The dollar of 1913 and the dollar of today share a name. Almost nothing else. The purchasing power that existed when the system was created has been eroded across more than a century of decisions, made by an institution that most people interact with daily, through their mortgage rates, their savings returns, their cost of living, and couldn't describe in any detail if asked. That's not coincidence. Systems that require public compliance tend to function better when the public doesn't examine the mechanics too closely. This is where it shifts, and here's where the pattern becomes impossible to ignore. The conversation happening right now about digital currencies, about central bank digital infrastructure, about the future of money itself, is following the same sequence. A problem is identified. A solution is proposed. The solution requires new architecture, new authority, new systems through which ordinary financial life flows. And the institutions designing that architecture are, again, not elected, not directly accountable, not operating in public view. The language is different. The terms are modern. But the sequence, crisis, solution, new control infrastructure, public dependence, is the same pattern that built 1913. Expanded after the Depression, resurfaced in 2008. It doesn't change because it doesn't have to. It works. In 1913, most Americans had no idea what was being constructed. They heard stability, they heard protection, they heard independence, and they believed it because they wanted to. Because the alternative was more panic, more collapse, more years of watching everything they'd built disappear overnight. Fear is the oldest tool in the architect's kit. Create enough of it, and people will accept almost any structure that promises to make it stop. The structure built in 1913 is still standing. It has survived every crisis it was supposed to prevent. It has grown through each one. And somewhere right now, in meetings you weren't invited to, in language calibrated to be too technical to question, the next iteration is being designed. The same argument, the same promise, the same sequence. Most people will accept it, because most people always have. The only question worth asking isn't what they're building, it's what you'll be agreeing to, without knowing it. If you can see the pattern, you're already ahead of most people.